Welcome to our deep dive analysis of Citigroup's Q1 2026 financial results. This quarter marks a major turning point for the bank, with revenue hitting its highest level in a decade. We're finally seeing the results of the Fraser turnaround strategy. Before we break down these impressive numbers, please take a moment to like this video and subscribe to the channel for more professional earnings analysis and corporate deep dives. Let's get started. Citigroup has delivered an exceptionally strong start to 2026, marking what CEO Jane Fraser describes as the best revenue quarter in a decade. For the quarter ended March 31st, 2026, Citi reported managed net revenue of $24.6 billion and net income of $5.8 billion. These results represent a significant acceleration in the bank's performance, with net income growing a staggering 42% year over year. Diluted earnings per share came in at $3.06, driven by broad-based outperformance across nearly all business segments. The firm's return on tangible common equity, or ROTCE, reached 13.1%, well ahead of the full-year targets. This performance underscores the successful execution of the bank's multi-year simplification and transformation program. As we analyze these headline figures, it becomes clear that the strategic pivot toward high-return businesses like services and markets is yielding tangible results. Jane Fraser noted that the bank is off to a strong start, with both the top and bottom lines showing robust growth. This introductory slide sets the tone for a presentation defined by operational efficiency, strategic clarity, and a return to industry-leading profitability as the Fraser turnaround officially arrives in full force. A closer look at the headline financial results for Q1 2026 reveals a comprehensive beat on nearly every key metric. Total revenue of $24.63 billion grew 14% year over year, comfortably exceeding the consensus estimate of $23.53 billion. Net income reached $5.8 billion, up 42% from the $4.1 billion reported in Q1 2025, which analyst consensus had significantly underestimated. The diluted EPS of $3.06 beat the consensus by 41 cents, representing a 56% surge. Markets revenue was a specific highlight, crossing the $7 billion mark for the first time at $7.2 billion, a 19% increase. Returns were equally impressive, with ROTCE hitting 13.1% compared to 9.1% a year ago, exceeding the full-year target range of 10 to 11%. The bank's capital position remains fortress-like, with a CET1 ratio of 12.7%, well above regulatory minimums. Tangible book value per share grew to $99.01, with total book value reaching $112.22. This capital strength allowed for $6.3 billion in share repurchases during the quarter, representing a 134% payout ratio when combined with dividends. These results demonstrate Citi's ability to drive massive shareholder value while simultaneously completing a complex institutional transformation. The quarterly revenue trend visualization confirms that Citi is currently enjoying its best performance period in 10 years. Looking at the 5-quarter trend from Q1 2025 to Q1 2026, managed net revenue has climbed from $22 billion to over $25 billion, a 14% total increase. This growth has been remarkably consistent, with steady quarter-over-year improvements even during the peak phases of the bank's restructuring. The 14% revenue growth was paired with a massive 56% jump in EPS and a 42% rise in net income, highlighting the powerful operating leverage Citi has built into its new model. CEO Jane Fraser noted that 4 out of 5 business segments delivered double-digit growth this quarter, a sign of broad-based outperformance rather than a one-time market fluctuation. This consistent upward trajectory is the definitive evidence that the turnaround is taking hold. By simplifying the organization and focusing on interconnected core businesses, Citi is successfully translating volume growth into superior bottom-line results. The revenue curve shown here illustrates a bank that has moved beyond the trough of its transformation and is now entering a phase of sustained expansion and competitive profitability in the global financial landscape. Citi's new organizational structure, focused on 5 interconnected businesses, is proving to be a highly effective growth engine. In Q1 2026, all segments showed positive momentum. The services segment, Citi's most differentiated franchise, grew revenue 17%, driven by a 17% rise in Treasury and Trade Solutions and a 20% jump in net interest income as deposit spreads widened. Markets revenue surged 19% to $7.2 billion, crossing the $7 billion milestone for the first time, with equities trading up a remarkable 40%. The banking segment reported 12% growth, fueled by record M&A advisory fees and a 64% surge in equity underwriting as global IPO markets reactivated. Wealth management revenue grew 11%, now including retail banking, with returns showing steady improvement. Even U.S. consumer cards, which underwent a segment restructure this quarter, grew 4% and delivered returns near 20%. This diversified performance confirms that the flywheel effect between services, markets, and banking is real. By serving the entire life cycle of corporate and institutional needs, Citi is capturing more high-margin business from its global network. The synchronization of growth across these 5 distinct yet related units provides Citi with a resilient and scalable revenue profile. A deeper dive into services and markets reveals why they are considered Citi's primary revenue engines. The services segment brought in $5.5 billion this quarter, up 17%. This unit benefits from Citi's unmatched global network, spanning over 180 countries. Treasury and Trade Solutions saw revenue rise 17% on higher deposit balances and a 20% increase in NII. Security Services also expanded globally, increasing its custody and fund administration reach. This segment is highly defensive and difficult for competitors to replicate due to its sheer scale in cross-border payments. Meanwhile, the markets division reached a historic $7.2 billion in revenue, up 19%. Equities trading led the charge with a 40% surge, while fixed income remained strong across commodities and emerging markets. Geopolitical volatility, particularly in the Middle East, boosted client hedging activity, which Citi was well positioned to facilitate. The reopening of the corporate deal pipeline led to record first quarter M&A advisory fees and a 64% jump in equity underwriting. Together, services and markets provide a powerful combination of recurring fee income and high-volume trading revenue, ensuring that Citi can thrive across varying market cycles while maintaining its dominant position in international finance. The Fraser transformation is now 90% complete, a milestone that significantly de-risks the Citi investment thesis. Key achievements this quarter include the final exit from Russia in February 2026, which removes a major source of emerging market regulatory and operational risk. The divestiture of Banamex is also progressing, with 49% to be sold and a plan for deconsolidation by early 2027. The sale of the Polish consumer business is on track to close this summer, part of a wider exit from 12 international consumer markets. On the operational side, the 20,000-person workforce reduction is nearly complete, resulting in a leaner org chart with much clearer reporting lines and accountability. The remaining 10% of the transformation is primarily focused on improving data quality for regulatory reporting, with internal audits and regulatory assessments to follow. Looking ahead, the May 2026 Investor Day is expected to be a major catalyst, where management will outline the post-transformation growth strategy and set new, higher financial targets. This slide documents an incredible management feat, simultaneously shrinking the bank's non-core footprint while driving its core businesses to record revenue levels, all while maintaining a strong capital position. Capital strength and shareholder returns are in a very robust position as Citi enters its post-transformation phase. In Q1 2026, the bank returned a record $6.3 billion to shareholders through share repurchases, representing a massive 134% payout ratio. An additional $1.1 billion was paid out in common dividends. This aggressive return of capital was made possible by the bank's high earnings and strong capital ratios. The CET1 capital ratio stands at 12.7%, which is well above regulatory requirements and provides ample flexibility for further buybacks. Book value per share reached $112.22, while tangible book value per share grew to $99.01. Credit quality remained remarkably stable throughout the quarter, with no material deterioration in either the consumer or wholesale portfolios despite the higher rate environment. total assets remain steady at approximately $2.78 trillion, with loans and deposits growing specifically within the high-return core businesses. Citi remains structurally asset-sensitive on non-USD currencies across its 65-plus markets, which provides a hedge against domestic rate volatility. The 13.1% ROTCE achieved this quarter far exceeded the 10 to 11% full-year target, placing Citi firmly on track to meet or exceed its long-term financial guidance. Citi's progress on return on tangible common equity and efficiency improvement is one of the most compelling parts of the turnaround story. The ROTCE trajectory shows a steady climb from 9% in Q1 2025 to 13.1% in the current quarter, significantly exceeding the bank's full-year target. This improvement is being driven by both top-line growth and rigorous expense management. The bank is guiding toward an efficiency ratio of approximately 60% for the full year 2026, supported by the nearly completed 20,000-person headcount reduction. Operating expenses were well controlled at $14.25 billion this quarter, providing positive operating leverage as revenue grew significantly faster than expenses. Citi has achieved a 3-year revenue CAGR of 11%, demonstrating consistent organic growth across its core business units. This combination of double-digit revenue growth and falling headcount is the holy grail of banking turnaround strategies. The upcoming Investor Day in May 2026 will be the venue where management unveils the next set of targets and the path to even higher returns. These metrics confirm that Citi is no longer a restructuring story, but is now a high-performance institution capable of delivering sustainable industry-leading efficiency and returns to its shareholders. The 2026 outlook and the upcoming May Investor Day represent a significant strategic window for Citigroup. Management has reaffirmed its full-year ROTCE target of 10 to 11%, though the first quarter performance of 13.1% suggests significant upside potential. The bank is targeting an efficiency ratio of 60%, aiming for continued positive operating leverage. Net interest income in the non-market segments is expected to grow 5 to 6% year over year, supported by balance sheet expansion and higher deposit spreads in the services and wealth units. Non-interest revenue is also expected to maintain its momentum across services, banking, and wealth throughout the remainder of the year. Crucially, management has stated that no acquisitions are planned, focusing entirely on organic growth through deepening client relationships rather than M&A. All excess capital is earmarked for return to shareholders. The May 2026 Investor Day will be the most important event for the bank in years, where Jane Fraser is expected to unveil new long-term ROTCE targets, segment-specific goals, and a 3 to 5 year growth roadmap. This outlook reflects a management team that is confident in its new, leaner structure and ready to compete aggressively on a global scale. In summary, Citigroup's Q1 2026 results represent a major victory for the Fraser management team. The bank reported its best quarterly revenue in a decade, beating estimates on both the top and bottom lines. EPS grew 56%, and net income rose 42% to $5.8 billion. The growth is exceptionally broad, with 4 out of 5 business segments delivering double-digit revenue increases. Services and markets remain the core engines, with markets revenue crossing the $7 billion threshold for the first time. The ROTCE of 13.1% is a standout figure, significantly exceeding the full-year target and proving that the bank's new structure is highly efficient. Shareholder returns were at record levels, with a $6.3 billion buyback driving the stock to a 20-year high. With the transformation now 90% complete and the Russia exit finalized, Citi has effectively removed its major legacy risks. As we look toward the May Investor Day, the bank is positioned as a high-growth, high-return leader in the global financial sector. The Fraser turnaround is no longer a promise, it is a proven reality, and Citi is now set to deliver a new era of sustainable growth and capital returns. That concludes our professional results analysis of Citigroup's Q1 2026 performance. The Fraser turnaround has clearly arrived, and the bank is firing on all cylinders. What part of this massive earnings beat surprised you the most? Is it the record buybacks or the 40% surge in equities trading? Let us know your thoughts in the comments. Don't forget to like and subscribe for more in-depth corporate financial reports. Thanks for watching, and we'll see you in the next analysis.